It's pretty wild, right? We just kind of take it for granted, the whole financial system, Like, have you ever really stopped to think about what's actually going on behind the scenes? What makes it like a truly modern system?
Yeah, I mean, it's not something most people think about every day.
Right. But we're about to dive into an idea that might just change the way you think about money altogether.
I'm all ears.
So imagine this. Your assets aren't just static numbers sitting in an account somewhere.
Okay.
They're dynamic, they're programmable, almost like little pieces of software.
Interesting. So more than just numbers on a screen.
Way more. That's what we're digging into today, this whole concept of tokenization. And we've got a really insightful report to guide us here. It's from Ripple and Boston Consulting Group, fresh off the press, April 7th, 2025. They call it Approaching the Tokenization Tipping Point, which is, well, a pretty bold statement.
A tipping point.
Yeah.
So they're saying this isn't just some small tweak.
Not at all. This report argues that we're on the cusp of a complete transformation of the financial system as we know it.
Wow, that's a big claim. But what exactly does that even mean for the average person? Like, how would our lives actually be different?
Great question. So the report lays out this vision of a financial system that's totally programmable. Like, rules and logic are baked right in.
Okay.
It's interoperable, meaning all these different systems can talk to each other seamlessly.
Okay, yeah, that's a big one.
It's always on 24/7, no downtime. It's instant with near immediate settlement, no more waiting days for things to clear.
Right, that would be amazing.
And it's way more accessible, opening up finance to a much wider range of people.
Yeah.
I mean, compare that to what we have now, which can feel, honestly, kind of clunky and slow sometimes.
Yeah, no, you're totally right. It's not exactly the most user-friendly experience.
So before we go any further, let's define our terms here. Tokenization, what are we actually talking about?
Sure. So at its core, tokenization is about taking the ownership and value of an asset, could be stocks, bonds, real estate, you name it, and recording it on a shared digital ledger. This record, the token, becomes a kind of digital representation of that asset. And because it's on this shared ledger, it can be transferred anytime, anywhere. It's like a digital certificate of ownership that you can trade 24/7.
And the really cool thing is, these tokens can represent almost anything of value. It's not just limited to financial instruments.
Exactly. And that opens up a whole world of possibilities. For example, think about fractional ownership. You could own a tiny slice of a huge commercial building or a famous piece of art.
That's right. And transactions would settle almost instantly. No more waiting days or weeks for things to go through. And because you can build compliance rules right into the token itself, you essentially automate a lot of the checks and balances that can slow things down now.
It's like having the rule book built into the asset itself. You don't need someone to double check everything manually.
Right. It just happens automatically.
Yeah. So I get the concept. But honestly, blockchain has been around for a while, right? What makes now the tipping point? Why all the hype all of a sudden?
Yeah, that's a crucial point. So the report highlights this convergence of factors that are really driving the change. For one, the technology itself has matured.
Okay.
It's more reliable, more scalable for enterprise use.
Makes sense.
Plus, we're seeing real progress on the regulatory front. More jurisdictions are developing clear frameworks for digital assets, which removes a lot of the uncertainty that was holding things back.
Yeah, regulation is huge.
But maybe the biggest factor is that major financial institutions are starting to see the potential here. They're not just dipping their toes in anymore.
You're jumping in with both feet.
It seems that way. They're starting to understand that tokenization isn't just some tech experiment. It's a fundamental shift in how finance is going to work in the future.
So this is way bigger than just a fad.
Absolutely. And that has major implications for all of us. If financial institutions are becoming more efficient, more innovative, that should ultimately benefit consumers like us.
Yeah, you'd hope so.
The report definitely makes that case. They argue that early adopters in the financial world stand to gain new revenue streams, access to a wider client base, a way to stay relevant in this changing landscape. It's becoming more and more clear that tokenization isn't just some optional side project. It's a crucial step in the evolution of finance.
Okay, yeah, I'm starting to see how this could be really transformative.
There's this quote in the report that really struck me. Jorgen Wachnein from Euroclear, he said, "Without industry alignment on shared infrastructure, we risk creating more silos and fragmentation, the very challenges we aim to overcome."
It's a good reminder that everyone needs to be on the same page here, right?
Totally. You don't want all these different platforms operating in their own little bubbles.
Exactly. You need that collaboration to really unlock the full potential of tokenization.
So how has this market been developing so far? Has it been like a straight shot up, or has it been more bumpy?
Well, it hasn't been the smoothest ride. In the beginning, tokenized assets were kind of lumped in with the broader world of digital currencies. Yeah, I remember that. Crypto was all the rage.
And as you know, crypto can be pretty volatile. So when things went south in the crypto market in 2022, tokenized assets kind of got caught in the undertow.
It makes sense.
But the report shows that things have really picked up since early 2023.
Oh, really? That's good to hear.
Yeah, the market has rebounded strongly with double-digit compound annual growth rates. It seems like there's a renewed sense of optimism.
That's encouraging, but I'd imagine different assets are being adopted at different rates. Like some things make more sense to tokenize than others, right?
Absolutely. And Laurent Marachini from Standard Chartered actually makes that exact point in the report. He says tokenization is gaining the most traction in areas where it offers clear, practical benefits. Things like making trading more efficient, creating new ways to invest. It's not a one-size-fits-all kind of thing.
Yeah, that makes sense.
So what are the big drivers behind this renewed growth? The report breaks it down into structural forces and market forces. Let's dive into those, shall we?
Sounds good.
On the structural side, it's really about regulation, technology, and infrastructure.
Okay, the foundations.
Exactly. We're seeing more and more countries clarifying their legal frameworks around digital assets, which is really important for giving institutions the confidence to move forward.
Right, you need those clear rules of the road.
And the blockchain technology itself is getting more sophisticated. It's becoming more robust, more scalable, easier to integrate into existing systems.
And that makes it more practical for real-world use.
Right. And then there's the infrastructure piece, things like digital wallets becoming more user-friendly, more integrated into our everyday lives. That's really crucial for getting everyday people comfortable with this technology.
It's like the on-ramp to this whole new financial world.
Now let's talk about the institutional side.
The big players.
So we're seeing major banks actually adopting blockchain for real-world applications, cross-border payments, automated settlements, that kind of thing.
So they're not just experimenting anymore.
No, not at all. The report mentions JP Morgan's Connexes platform, which has already processed, get this, over $1.5 trillion in tokenized transactions.
Wow. Okay, that's serious volume.
Yeah, daily volumes exceeding $2 billion. That's real scale. And we're seeing other big players making moves too, buying up fintech companies to accelerate their entry into the tokenization space.
So the big guys are definitely taking notice.
And then there are the market forces, what investors want.
Yeah, because ultimately they're the ones who will be using this.
Right. So there's this thing called the follower effect. As early initiatives prove successful, more people want to get involved, both issuers and investors.
It's the I want what they're having phenomenon.
Exactly. And we're also seeing this learning effect as early movers figure out what works and what doesn't and share their knowledge.
Learning from each other's mistakes is always a good thing.
Plus, the types of assets being tokenized are expanding. It's not just stocks and bonds anymore. It's commodities, gold, oil, agricultural products.
Makes sense.
And maybe most importantly, there's this growing demand from a new generation of investors.
People who are more tech savvy?
Exactly. People who have grown up in a digital world and are much more comfortable with these kinds of assets.
So it's partly a generational shift.
Now let's get to the really exciting part. Growth projections. And the numbers are pretty mind-blowing.
Okay, hit me with it.
So the report projects that the market for tokenized real-world assets, this is their central estimate, is going to go from about $0.6 trillion in 2025 to a whopping $18.9 trillion by 2033.
Whoa, hold on. What was that last number?
18.9 trillion. That's a compound annual growth rate of 53%.
53%. Okay, yeah, that's impressive.
To put it mildly, they do offer more optimistic and conservative estimates ranging from 12.5 trillion to 23.4 trillion, but either way, you're talking about a massive amount of growth.
That's huge.
Now, how's that growth going to be distributed across different types of assets?
Good question. Because it can't all be in one basket.
Right. So the report dives into this in detail. By 2033, they're expecting significant volumes in deposits and stablecoins. Also, a big chunk in a broad category of alternative investments and real-world assets.
Okay.
Lending and credit, real estate, and treasury and short-term liquid assets are also projected to be substantial.
Interesting.
Then looking further out, they see growth in tokenized equities, derivatives, traditional fixed income, alternative investments like private equity and hedge funds, and investment funds more broadly.
Wow, so pretty much every corner of the financial world
Oh,
eventually.
it seems that way.
And which industries are going to be the main drivers of all this? Where's the action going to be?
Well, initially, they're expecting payments and fintech companies to be at the forefront, along with the consumer and healthcare sectors.
Okay, that makes sense. Those are already pretty tech-forward industries.
Right. Then, as things progress, they see alternative investment firms like private equity and venture capital becoming major players. Also, the technology and digital sector, retail and universal banking, and even traditional industries like manufacturing and resources.
Interesting. So not just the usual suspects.
Private banking and wealth management, government and regulatory bodies, and investment and corporate banks are also expected to play key roles. It's really going to touch almost every part of the economy.
So it's a pretty global phenomenon.
It is, but it's not a uniform rollout.
What do you mean?
The report highlights that different regions are adopting at different speeds based on their specific needs and regulatory landscapes.
Okay, so it's not a one-size-fits-all approach.
Not at all. The U.S., for example, is seeing a lot of action in tokenized funds, government securities, and collateral, partly because there's more regulatory clarity there.
Makes sense.
Europe is moving forward under their MiCA framework, which aims to harmonize regulations across the continent. Switzerland has been an early leader with a really comprehensive legal framework already in place.
Yeah, they're often ahead of the curve.
The Middle East is showing strong interest in tokenizing real estate and private credit, which aligns with their strengths. In the Asia-Pacific region, there are tons of pilot projects focused on funds, bonds, and structured products, particularly in places like Japan, Singapore, and Hong Kong.
Makes sense. They're financial hubs.
Latin America, especially Brazil, is growing through fintech platforms and USD-denominated tokenized assets. And in Africa, the focus is often on remittances and creating stable financial instruments, leveraging the widespread use of mobile technology and stablecoins.
So it's really a diverse global picture with different regions finding their own niches.
It is. Now, the report talks about these twin flywheels of adoption, which sounds like a self-reinforcing cycle.
It does, like a positive feedback loop.
Exactly. So on one side, you have businesses investing in developing and improving their tokenized asset offerings.
Okay.
This leads to benefits like faster time to market for new products, real-time transactions, cost efficiencies through automation, and the removal of unnecessary intermediaries.
So the more they invest, the better the offerings get.
Right. And those improvements create more awareness and demand, allowing businesses to attract more clients and offer even more diverse products. It's a virtuous cycle on the supply side.
Makes sense. Yeah, what's the other flywheel?
Well, the other side is focused on customer adoption.
Okay.
As businesses offer more compelling features through tokenization, things like fractional ownership of assets, enhanced privacy and security, logistical improvements, customers become more trusting and see more value in these offerings.
Okay, yeah.
And that increased trust and value attracts more customers, both individuals and institutions. And as more people get involved, the whole cycle accelerates.
So it's a two-way street. Businesses are creating better offerings, and customers are responding with greater adoption.
Exactly. And both of those flywheels are fueled by this fundamental driver, the growing number of asset owners and customers who choose to use tokenized assets.
So it's really about building momentum.
Now, there are certain things that can help these flywheels spin faster, what the report calls enablers.
Things that grease the wheels, so to speak.
Right. And these include clear guidance and support to educate potential users.
Okay, so people understand what they're getting into.
Acceptance from both regulators and established institutions, which gives people confidence.
Yeah, legitimacy is important.
Streamlining things like Know Your Customer, KYC, and onboarding processes, which makes it easier for people to get involved.
So removing barriers to entry.
And a spillover of familiarity from the crypto world to traditional finance applications of tokenization. As people become more comfortable with crypto, it becomes easier to embrace tokenization in other areas.
That makes sense. It builds on that existing familiarity.
And of course, greater global accessibility to financial products is a huge driver. The report quotes Yu Hong Xing from BCG Hong Kong, who says tokenized real-world assets have incredible potential to reach underserved populations.
So this isn't just about making the rich richer.
Not at all. It's about opening up access to financial services for people who have traditionally excluded.
Okay, that's really promising.
Now, let's talk about the customer experience. Will people even know that their transactions are using tokenized assets?
That's a good question. I imagine most people won't.
The report suggests that in many cases, the complexity will be largely invisible. What people will experience are the benefits: easier access, lower fees, faster settlements.
Okay. So they'll just see things working better without necessarily knowing why.
Right. But for more sophisticated investors, digital assets will likely play a more explicit and strategic role in their portfolios. So the level of awareness will vary depending on the user.
That makes sense.
Now, the report outlines three distinct phases in the adoption of tokenized assets. Where do you think we are now, and what can we expect as we move forward?
Well, it seems like most firms are still in the early stages of phase one or just starting to dip their toes into phase two. Phase one, which they call low-risk adoption, is all about institutions testing the waters with familiar regulated instruments. Think things like money market funds and short-term corporate bonds.
Okay, so the low-hanging fruit.
The focus in this phase is mainly on operational efficiency and making sure things comply with existing regulations.
So not rocking the boat too much.
Right. Some examples of this phase include the launch of BlackRock's tokenized money market fund and the inclusion of tokenization in the BIS's Project Guardian. It's about getting comfortable with the technology and building internal expertise through pilot projects. Vid Krajbar from Raiffeisen Bank International AG actually says that banks are actively preparing by doing these pilots and setting up the necessary infrastructure.
So phase one is about laying the groundwork. What about phase two?
Phase two, which they call institutional expansion, is where things get a bit more interesting.
Okay.
Institutions start to tokenize assets that offer higher yields and are more complex. Things like private credit, structured finance products, and more sophisticated types of corporate bonds.
So moving beyond the basics.
Exactly. This phase requires more flexible compliance solutions, the development of secondary markets to facilitate trading, and the ability to reach a wider range of investors.
Yeah.
It's about unlocking more value, not just efficiency.
So what are we seeing in this phase?
Well, there's a move towards using permission public blockchains to increase liquidity and interoperability. We've seen initiatives from Societe Generale and CD, for example, and there's also a lot of experimentation with tokenizing less liquid assets like real estate and infrastructure through special purpose vehicles, SPVs, and fund wrappers like real estate investment trusts, REITs.
So it's getting more sophisticated.
It is. But the report also notes that some players might be hesitant to move too quickly in this phase.
Why is that?
Because tokenization has the potential to disrupt existing revenue streams. Some businesses might not be so eager to embrace a technology that could undermine their current business models.
That's always a challenge with new technology. It's disruptive. So what about phase three, the final stage?
Phase three, which they call market transformation, is when things get really interesting. This is where tokenization extends to traditionally illiquid asset classes like private equity, hedge funds, and infrastructure debt.
Wow, okay, that's a big shift.
It is. And it's heavily dependent on achieving sufficient liquidity in secondary markets, widespread acceptance of tokens as collateral, comprehensive regulatory frameworks, and robust institutional infrastructure. It's going to require a ton of coordination across the industry.
Sounds like a tall order.
It is. But the report argues that the drivers in this phase will be clear profitability, efficiency, and the potential for further innovation.
So each phase builds on the last with increasing complexity and a broader impact on the financial system as a whole.
Exactly.
Now, the report delves into 5 specific use cases for tokenization, highlighting the potential efficiency gains in each.
Okay.
First up, investment-grade bonds, a $140 trillion global market.
Wow, that's a lot of bonds.
It is. And tokenization could address some of the big inefficiencies there, like high issuance costs, slow settlement processes, and the need for multiple intermediaries. The report estimates potential operating cost reductions of 40 to 60% and the possibility of near-instant settlement.
Those are some serious gains.
Yeah. They cite examples of early movers like ABN, AMRO, HSBC, and the European Investment Bank.
So big names are already working on this.
And they estimate that for a $100 billion bond issuance, you could save between $40 and $60 million annually.
That's not chump change.
Not at all. Now, what about real estate? That's another area that's ripe for disruption, right?
That's absolutely. It's a huge market, over $300 trillion globally, but it's notoriously illiquid and opaque.
Right. Tokenization could change that by enabling fractional ownership so more people can participate. Now, regulatory frameworks often require using structures like SPVs or REITs to stay compliant.
Yeah, those are important considerations.
But we're already seeing platforms in places like Switzerland and the UAE attracting global investors to tokenize real estate.
Okay, so it's happening.
The report suggests that tokenization could unlock an additional $500 million to $1 billion in new capital for a $5 billion real estate fund.
Wow.
And they estimate administrative cost savings of $100 to $150 million over 5 years.
So tokenization could make real estate investing more accessible and more efficient.
Exactly. Now, those are two use cases that are gaining traction now, but the report identifies three others that rely on more developed markets.
Okay, let's hear about those.
So the next one is collateral and liquidity management. That's a $16 trillion global market.
Wow.
Tokenization can enable on-chain pledging of collateral, real-time transfers of assets, and the use of smart contracts to automate margin management.
Okay, so streamlining the whole process.
Right. For a bank with a daily repo volume of $100 billion, they estimate potential annual savings of $150 to $300 million.
Okay, that's huge.
But to realize those gains, you need widespread adoption of interoperable token standards and clear regulatory frameworks.
Yeah, that infrastructure needs to be in place.
Now, let's talk about trade finance.
An area that's always ripe for disruption.
Right. Despite a global volume exceeding $10 trillion, it still relies heavily on paperwork and manual reconciliation processes.
Yeah, it's very old school.
Tokenization can bring real-time invoice settlement, programmable payments linked to the movement of goods, and better access to liquidity for businesses involved in international trade.
Okay.
They suggest a potential unlock of $2 to $4 billion in working capital and a $20 to $50 million reduction in financing costs for a firm with an annual trade volume of $50 billion.
Wow, okay. That would be game-changing for a lot of businesses.
It would. But again, this relies on the standardization of digital trade documents and the legal recognition of smart contracts across different jurisdictions.
We're not quite there yet.
Not yet. And finally, let's talk about treasury and cash management.
How can tokenization help with that?
Well, a lot of big companies hold tons of cash in low-yield accounts.
Yeah, cash that's just sitting there doing nothing.
Exactly. Tokenization lets corporate treasurers deploy this idle cash into higher-yielding money market funds. They can also execute instant foreign exchange transactions using stablecoins and automate intraday liquidity management across different accounts. For a multinational company with $1 billion in idle cash and $10 billion in annual payments, they estimate potential gains of $15 to $25 million in additional yield, $3 to $12 million in savings on FX and processing costs, and $35 to $100 million in improved liquidity and working capital management.
So basically making that cash work harder for them.
Exactly. So across all these use cases, the potential for gains in efficiency and new opportunities is pretty clear.
Yeah, it's definitely compelling.
Yeah.
But I imagine there are also challenges and risks to consider, right?
Of course. It's not all smooth sailing. The report outlines 7 key challenges that need to be addressed.
Okay, let's hear those.
First, adoption needs infrastructure to scale.
Meaning what?
Well, we have all these pilot projects, which are great, but they often operate in isolation.
Yeah, they're not connected.
And the rate of adoption is, in some areas, actually outpacing the development of truly interoperable solutions and unified onboarding processes.
Okay, so we need to build the bridges between these islands, basically.
Exactly. The second challenge is that institutions need to align on core infrastructure.
What does that mean exactly?
The report argues that the real value will come from the products and services built on top of this infrastructure, not from each institution developing its own proprietary system.
So collaboration is key.
Yeah, they need to work together on the foundation, then compete on the services they offer on top of it.
Makes sense.
There's also this strategic decision for institutions to make. How much control do they want over things like wallet infrastructure?
Right, that's a big one. Do they build it themselves or partner with someone else?
Exactly. And then there's regulation, which is always a big factor in finance.
Yeah, you can't escape the regulators.
While there has been real progress in several jurisdictions, the global regulatory landscape is still fragmented. The report emphasizes the need for the industry to be actively involved in shaping future regulations.
So working with regulators, not against them.
Exactly. And then there's interoperability, which is a big hurdle right now.
Why is that such a challenge?
The main constraint is the lack of seamless cross-platform settlement, especially achieving delivery versus payment DVP directly on-chain. DVP is this crucial concept where the transfer of the asset happens at the same time as the transfer of funds.
So it's about ensuring that both sides of the transaction are protected.
Right. But a lot of platforms right now can't communicate and settle transactions directly with each other. The cash leg often has to settle off-chain, which limits adoption and scalability.
Okay.
And the lack of standardization in how smart contracts are designed and implemented also creates friction between different systems.
So it's kind of a mess right now.
Well, it's early days, but it's definitely something that needs to be addressed.
Yeah, if we want this to really take off.
Now, trust is obviously crucial in any financial system. How does tokenization build that trust?
Well, the report suggests that trust will come from performance. As tokenization moves into this more regulated world of institutional finance, with its emphasis on transparency and compliance, trust will be earned through demonstrable results: faster settlements, lower costs, seamless integration with existing systems.
Okay, so it's about proving that it works.
Exactly. If it can deliver on its promises, trust will follow.
And then there are the costs involved. We talked about initial investment earlier. How do those factor into the challenges?
So launching a focused pilot project can be relatively manageable cost-wise, but achieving full integration across an entire institution, across different functions and asset types, that's a significant investment.
Okay.
However, the long-term view is that as the technology matures and we achieve greater scale and interoperability, tokenization platforms will actually be more cost-effective than maintaining legacy systems.
So it's a short-term cost for a long-term gain.
Exactly. It's about investing in the future.
And finally, the last challenge looks beyond the immediate applications to what might be possible down the road.
Looking ahead.
The report emphasizes that the systems we build now need to be designed with future innovations in mind. Tokenization is just the base layer.
Okay.
On top of that, you could have on-chain collateral management, programmable liquidity solutions, even AI-managed assets.
Wow, so it's really just the beginning.
Exactly.
Yeah.
Institutions that adopt flexible and forward-thinking systems now will be much better positioned to adapt to whatever comes next.
So think long-term.
Absolutely. So with all these potential benefits and challenges, when does tokenization make the most sense? Are there situations where traditional methods might still be better?
That's a good question. The report acknowledges that there's still some skepticism around tokenization and that it can disrupt existing business models, particularly for intermediaries.
Okay.
They argue that tokenization is most likely to be beneficial for assets that have inherent problems: limited liquidity, inefficient trading processes, long settlement times, high transaction costs. It might not offer as much advantage in markets that are already very efficient.
So it's not a magic bullet for everything.
Right. It's about finding the right fit. The report actually offers 5 questions that firms should ask themselves when evaluating potential tokenization opportunities.
What are those?
First, does it provide significant access to new asset classes, ideally globally?
Okay.
Second, does it offer massive cost reductions and efficiency gains compared to existing methods?
Makes sense.
Third, does it enable fractional and easily transferable ownership of assets that were previously hard to divide or trade?
Okay.
Fourth, does it improve settlement speed and logistical efficiency?
Right.
And fifth, does it enhance trust and transparency in an asset class, perhaps by providing better provenance tracking or auditability?
Those are really good questions to ask. Now, let's talk strategy. How should different institutions approach this? The report outlines different playbooks for different players, right?
It does. They basically categorize institutions as either system builders or scalers and integrators.
Okay, let's break those down. Who are the system builders?
These are typically your large global institutions, big banks, major custodians, financial market infrastructure providers. They have the clout to shape the underlying infrastructure of tokenized finance.
Okay.
Their big strategic questions are: what's the right role for public versus private blockchains? How do we aggregate liquidity across platforms? What about custody solutions for digital assets? How much control do we want over digital wallets? How do we ensure broad distribution and client access? And how do we navigate the evolving world of compliance and digital identity?
Those are some heavy-duty questions.
They are. But these are the players who can really move the needle.
So what about the scalers and integrators?
These are your mid-sized and regional institutions. Their focus should be on leveraging their existing strengths and customer relationships.
Okay.
Maybe they create tokenized fund products for private banking clients, or offer tokenized real estate investments to wealthy individuals, or enhance trade finance.